You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Cboe. Cboe is one of the world's largest exchange holding companies, and we're inspired every day to innovate some of the industry's most powerful products, technology, and solutions. We're the industry's leading force driving access to global markets, a better trading experience, and powerful data and analytics to inform better strategies. We're committed to engineering new ways to help our customers realize their potential and navigate the marketplace of tomorrow, today. Visit Cboe.com. That's CBOE.com to learn more about our expanded offerings. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. You guys know how to get us by now. iTunes, TuneIn, Stitcher, our website, wherever pretty much you like to find your favorite audio programs. We should be there, including, of course, for you hardcores, live every Friday, noon Central, 1 p.m. Eastern, via Mixlr, M-I-X-L-R. Grab that link, set it and forget it. That way you can join this show live, as well as TWIFO coming up in about an hour and a half later today. Option Block throughout the week, all of our other fun live shows that we do. Grab that link, or if you want to follow us in Mixlr, I know a bunch of you guys do that as well. That way you'll be notified the second we go live with these shows and some of the other surprise live shows that we do throughout the week. And however you listen, make sure live after the fact to keep those questions rolling. Even if you don't answer them on the show, we try to get back to you. And also, sometimes your questions provide us interesting talking points here on the show as well, things we hadn't considered. So we do like to hear from you guys. And joining me on the old program today, let's see, let's spin the Vol Views reel and let's see who we land upon. First off, I'm guessing he's not in parts unknown. He's back in the volatility mecca of Chicago. We are joined by Mr. Russell Rhodes, the man about town these days over there at the CBOE. Mr. Rhodes, welcome back to the program. How goes your post-concussion life? Uh-oh, Mr. Rhodes, did they kick you off there at the CBO?
Well, I was teaching, and then I was at Oklahoma and VIX.
That's actually, that wasn't a bad impression, actually. That wasn't bad. Mr. Rhodes, do we have you again? CBO needs to pay their internet bill.
Yes, you do, and,
there we
and
go.
I heard that.
It actually wasn't bad. It wasn't bad.
I heard things, so we'll just leave it at that.
Now that you're back,
I know where one of the towns that changed America is, Riverside. I know where you live, sir.
There we go.
Let's just hope they never write up a dossier about me based on you.
Oh my goodness gracious!
No memos.
I think we both have this really cool mutually assured destruction thing between us.
Yeah, we both have hydrogen bombs against the other.
Both of us quiet.
I concur.
Nothing like starting the show off with a little threat of mutually assured destruction. I like it. It's good for what ails you. That tinny voice, when he's not impersonating, I should say, Mr. Rhodes there. That tinny voice means we are joined also by none other than the greasy meatball, Mr. Mark Sebastian from OptionPit.com by way of Carmen Line Capital and whatever the heck the new fund's called. Mr. Meatball, welcome back to the show, sir.
Hey, yeah, no, we're that's a part of the Carmen Line Capital group. As it's just a secondary fund. The Broadcat Edge, it is officially open for business, and we're like super excited about it. And the good news is we have waited to trade, so we have not yet executed a single trade yet. I'm glad because if we had a couple of days and that put sale would look kind of ugly, wouldn't it?
Yeah, it would be a different environment these days. And I came up with a great name for you guys. I'm sad to see that someone already has the Prime Meridian Fund because that was a good one for you guys. I'll put my work to it and I'll see if I can come up with another cool line of demarcation. Somehow Mason-Dixon line doesn't have the same ring to it. Also comes with a lot of baggage. I don't think you guys want to deal with it. Also, I'll think about some other geographic or natural lines of demarcation for you, and I'll put together a nice little list for you. Maybe you listeners at home can write in with your suggestions. And also joining us on the revolving guest co-host seat today, he's a newcomer to the show and indeed to the network. He is Don Dale, the managing member over there at the Equity Risk Control Group. Don, welcome to the Volatility Views program.
Thanks very much. Good afternoon.
And Don, as we are wont to do with all of our first-timers here on the show, why don't you give our audience a little bit of an overview of your background in the options and derivative space, and then a little bit of a glimpse into what the heck you guys do over there at Equity Risk Control Group.
Well, thanks. I appreciate it. I am a 20-year industry veteran, for better or worse. I'm an ex-Susquehanna guy, for better or worse. We created Equity Risk Control to help fill a need with some institutional pools of equity capital and act as risk mitigation consultants.
I like it. It's interesting. We've had a lot of different people in your line of work on the show over the years. Don't worry, we won't hold your Susquehanna affiliation against you. We've had quite a few, I think a few of those guys, ex-Susquehanna guys floating around on the show. So no hard feelings there. But really quickly, maybe before we get rolling, I'm curious. Like I said, Don, we've had a lot of people in your kind of space on the show in the past. We've heard different stories anecdotally about what's going on in the fund space, how receptive funds, pension funds, and others are in general to the gospel of options coming knocking on their door saying, hey, would you like to hedge, or would you like to risk, would you like to learn about volatility? So I'm curious for you, before we even get rolling with the rest of the show here, what are you seeing out there anecdotally in the pension fund space? Are they starting to get a little more receptive to the idea when you guys call and say, hey, we want to talk about options and volatility and hedging? Or are they still, in the Stone Age, for lack of a better term, when it comes to these very basic but important concepts?
Well, that's a great question, and I definitely have noticed a substantial shift. And I can't say that the substantial shift has been created because of a lack of awareness of the benefits of the space. It's really a function of the recognition that their diversification through other asset classes, primarily fixed income, is not almost assuredly going to act as the buffer to any equity market pullbacks. And I think this has been widely accepted in the pension community. Whether or not they've acted in the derivative space or not is something that is up for debate. I would say that path-dependent hedging, where there is more of a fiduciary accountability, has been more actively implemented from non-traditional players. I would say that the VIX space is something that has still been hard to push through to in terms of the benefits of incorporating volatility specifically into the pension community. But broad market hedging orientations, we've seen lots of recognition of the fact that they need to take a look at either outsourcing it or doing something internally.
I'm glad to hear that. I always like to take the pulse of people who are out there like yourself in the trenches with the funds, the pension funds, hedge funds, and others, and taking the gospel of options and hedging to them and kind of hear what they're saying, hear what they're seeing and hearing out there, with their ear to the ground on the street, because you hear different things all the time. So I'm glad to hear. Who knows what's driving it, if it's like you mentioned, or if it's maybe just these valuations are getting so top heavy that even relatively permeable would have to think about hedging at this point. Who knows? Maybe it's a combination of all of the above. I know I was down at the Inside ETFs conference a few weeks ago, and pretty much everything back there was like it was 1981 from an options perspective. It was all just broad portfolio diversification and diversifying through multiple underlyings rather than any sort of hedging as we would construe it here on the program. So I'm glad to hear things are picking up in the fun land. Speaking of picking up, let's pick up with the show right now. Let's dive right into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Vol Review, the portion of the show where we do, surprise, surprise, some reviewing of this week's action, trades, trends, unusual activity, developments in the world of volatility. And oh, what a week it was and indeed has been. We saw VIX Cash at least come roaring back with a vengeance, actually topping the 15 handle at one point this week, 15 and a half, I believe, are pretty close therein. So I think all of us were fairly off that mark. Last week when it came to our prognostications. No one had it in the mid-teens by this week. Just a spoiler alert for the crystal ball a little bit later, listeners. And, of course, as we're recording this and streaming it live a little bit past noon central here, most of the major indices taking it on the chin just a wee bit. S&P off a little over 1%. The Dow actually leading the charge to the downside, off nearly 1.5%. And the tech-heavy NASDAQ bringing up the rear, off just shy of 1%. All this green on the screen, all this red on the screen means a little green on the VIX screen again as VIX Cash roaring back to life. It had been down in the 13 handle, now roaring back about a handle and a half, getting back over the 15 mark. So getting a little frothy out here to wrap up the week. So it's been a lot of interesting action. Don, as our guest, I will give you pride of place here on the old Volatility Review segment. A lot of things going off, a lot of interesting developments in the world of volatility this week. What in particular caught your eye?
The VIX Elephant came back in this morning and did his roll where he rolls from February into a farther out month to engage in his 260,000 by 520 by 260 collared call spread, 1x2 call spread. And that actually had a little bit of pressure on VIX volatility. The VVIX has popped to just shy of 120, which is right at the high end of the range over the last 60 days. And so that was noteworthy.
Yeah, our old friend, the VIX whale and the VIX elephant, or pick your large mammal of choice, whatever you want to call him. He was back in spades today. We'll get to his action in a little bit when we break down all the things that were going on out there in the big VIX mothership. But, if you're saying to yourself, wait, didn't we just talk about this guy? Yes, we did. On a very recent show. That's because his last trade was a little bit more out of sequence. This one is kind of more in line with everything that he has been up to. Speaking of everything he's been up to, Mr. Rhodes has been tracking all these sorts of fun things, and I'm sure he's been keeping an eye on all of the other fun things that are popping off in the world of volatility. A lot of things this week. Mr. Rhodes, what was catching your eye out there from a volatility perspective, sir?
Well, VVIX at a really elevated level, makes us feel like we're going to stay at these levels for some time. We've started to get reporter calls about higher volatility. And, the second I try to explain to them not to look at VIX within a vacuum, that there are other volatility indexes, and I get about that far, and then I can hear snoring or yawning or whatever on the other end of the line. They tend not to want to dig too deep into all of this. But VVIX running up till I can't remember the last time we saw 120 on VVIX. I've been watching the 3-month volatility index, and it has remained at a premium relative to VIX, and that's kind of significant. That's a common way to keep an eye on, contango versus backwardation, and typically there are participants that feel like the equity market move to the downside or the VIX move to the upside might be nearing an end when you get VIX at a premium to what we now call VIX 3M, and we're not there. So that I find that kind of interesting as well. Maybe we're actually going to hold at higher volatility levels for some time.
Yeah. VVIX certainly seems to be backing that up. That has been our historic zombie apocalypse indicator, more so than VIX call put or all the other many indicators that are floating around out there. So you're right. It has been some time since we've been at these lofty VVIX levels, hovering right around 119 as we're doing the show here, listeners. So things are moving, rocking and rolling. But of course, if you pay attention to the VIX complex this week, VIX has been moving, so that shouldn't come as too much of a surprise to you. Nevertheless, though, get your chainsaw ready or your samurai sword or your flamethrower. I think in our polls in the past, I think you guys have chosen flamethrowers. So maybe you want to go with that. Maybe you want to buy one of those cool new Musk $500 flamethrowers just for the zombie apocalypse. Either way, VVIX getting lofty, so perhaps you should be concerned. Let's turn now to the Meatball. Mr. Meatball, do you have your flamethrower ready? Are you concerned about these VVIX levels? And what are you doing for the zombie apocalypse?
Yeah, what I would say is that this is really the first time in a while that we've seen, as Mike and Matt, our boys at Typhon would say, a VIX swell. And that's where we've consistently seen a steady rally in volatility. Not, there's an event, VIX goes from 11 to 17 right back to 11. The last time we saw really anything like this was maybe August, where we had that 1 or 2 week period of real movement. And before that, I think we're really talking January of 2 years ago and February 2 years ago. And, I think that's kind of what's really fascinating about the market that we're seeing is that, outside of kind of one day where maybe things really moved, we've had nice sell-offs paired with a steady climb in volatility. And that to me tells me that there are a lot of people that are unwilling to just fade this. Now, it might turn around. It looked like for a second we were going to absolutely tank yesterday. But we had a bunch of positive data today, and we're in a weird, Russell, you're a credit guy, so you can probably comment to this as well. But we're in one of those weird scenarios where treasuries and the S&P 500 are correlating. And when that happens, good news is bad news is good news. And it can lead to volatility movement that we're seeing, a run from, we settled 875 about 2 months ago. And now we are 1530, and we've been consistently in backwardation for several days. We're now seeing the entire curve backwardate. We have Feb, which is maybe running out of time, trading over March, and we've got March almost flat with April. Watch out if March gets over April. That could be a real what the heck is going on. Now, that doesn't mean there's not opportunity. There is to trade between the different months. There's all sorts of spreading opportunities. I don't understand why the weekly futures are not why people are not picking off weekly futures traders left and right. I can sell the Feb regular contract at 1485, buy the Feb 7 and the Feb 21. So I could sell two, buy one of each. And of course now the Feb 7 moves. And I can do that for a really nice credit. So there's some really interesting calendar spreads around the weeklies that they're kind of letting go and probably should not be.
Yeah, you're right. I was looking at this while you were talking. I had the futures up here on my screen, and you're right. I was keeping an eye on the March just kind of does seem a little bit aberrant, all things considered. I think we have some listener questions a little later about how can the futures get so disassociated to the cash. We'll get to that in a little bit. I'm curious, Don, you obviously look at a lot of different factors in the volatility space. You've been around the space for quite some time. Any of these maybe on your horizon? Any of these maybe concerning to you? We're seeing lofty levels of VVIX now, well north of 100. We're seeing, as Mark alluded to, a lot of backwardation out there in the VIX futures. Or maybe are there some other maybe canaries in the coal mine you're keeping an eye on out there? What's really on your radar aside from what's trading, but kind of more of these indicator type things?
Well, we follow realized correlation in the S&P quite a lot. And realized correlation in the first few business days of this calendar year started elevating quite meaningfully on the powerful move up in the market, which when it usually happens in that magnitude outside of a big macro announcement, it usually translates into a predecessor for higher realized volatility for an extended period of time. And we were coming off of 0 percentile realized correlation in the S&P constituents, and everyone had spoken about this and seen this for some period of time, which is what kept or part of the reason why the VIX base level was as compressed as it was, of course. This move up, I think, is more global and cross-asset class in nature. Currency implied and realized vols have elevated significantly. As Russell had made note of with respect to the settlement in the VIX in December at 8.7, this is a substantial elevation, even discounting the day count orientation and the holidays that we had for the end of December. So this is a meaningful move, and we've seen the same type of move in currency realized vol and then in realized correlation. So there is a platform across the board for higher vol. And then one of the other things that I like to really watch is intraday total travel, both for the S&P and then for the VIX. And I think there was an allusion to it earlier in the conversation regarding the move that we've seen in the last couple days. We've seen some prints where we've opened up a point in the VIX Cash. We've traded off to unchanged or even down, and then traded back up to those previous early high levels. And these are really meaningful realized moves, even if it is the VIX Cash. The futures are in a more dampened environment, of course, but still moving in higher magnitude. So we're starting to see some higher realized volatility or total intraday travel numbers that are starting to warrant these higher VIX base levels. The implied vols for the VIX, that's a different issue entirely. Implied vols very high, as we made note of with VVIX, and realized on a 30-day trailing perspective is nowhere near where we are.
Yeah, it's a good point about the intraday travel. That's not one we bring up too often, specifically here on the show. We may allude to it, but it's not one we bring up. But your point about the realize is interesting. That's something we keep an eye on quite a bit here on the program. Obviously, that gulf, that chasm between realized and implied. And even last year with VIX Cash, all the headlines were VIX is anemic, volatility is anemic. There still was an enormous gulf between the implied, which was around still in single digits, but hovering around the high nines, and then the realized, which was in the 5.5 range for the better part of the last quarter or so out there. But now we're spiking all the way up towards around an 8 out there in 30-day realized vol out there in the S&P. So things are lofty. Things are looking crazy. Let's see what else is looking crazy, because it is time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
All right, everybody, you guys know the drill. It's the portion of the show where Mr. Rhodes holds court for 25 to 32 minutes on all things VIX Weekly Options. Mr. Rhodes, I think you actually may have a wealth of choices this week. So what caught your eye on the VIX Weekly Options front this week, sir?
There really aren't that many choices.
Really? The whale sucked all the oxygen out of the room?
Yeah, it kind of, I'd actually got a big old 0 on one of the days from last week. Thank God for Mondays. And that seems to be when we usually get most of our weekly activity. Very early Monday, looking at the Feb 7th expiration, somebody came in and bought a 12-15 call spread. They paid 88 cents for the February 7th 12 calls and sold the 15 calls for 34 cents. Got a cost of 54 cents on that guy. Probably feeling very smug about that trade right now. Somebody taking a look at, this, part of me wonders if this was a covering transaction. Somebody bought the January 31st 10 calls for $1.56 and sold the 10.5 calls for $1.11. That cost them 45 cents. If they held it through expiration, it was worth 50. So a quick way to pick up a nickel. And weekly settlement this past week was at 14.43. Somebody sold the February 27th 11.5 puts for 37 cents and bought the February 27th 19 calls. They did a very wide I can't remember the last time I saw a split strike spread like this that was that far apart. And they ended up paying 25 cents for that trade. I assume looking for some sort of spike, maybe into the 20s. They're going to feel very smart if VIX gets to levels we haven't seen in some time. And then finally, I always like to put bad trades in there. Somebody sold the January 31st 12 calls for 70 cents on Monday and bought the Jan 31st 13.5 calls for 23 cents. Took in a 47-cent credit, and that trade was basically a disaster if they held it through settlement. Tuesday, another call spread buyer. Somebody bought the February 7th 12 calls for $2.40 and then sold the 17 calls for 65 cents. Paid $1.85 for that. Looking fairly smart on the trade right now. I saw this one repeated a few times throughout the day, kind of at the same prices. Somebody did they sold two of the February 7th 12 puts for 38 cents each and bought one of the February 7th 13 puts for 87 cents. Paid 11 cents for that trade. And we will see if things come back in line for them. And then finally, looking at Tuesday, somebody bought the February 7th 14 calls for $1.29, sold the February 7th 16 calls for 78 cents. Paid 49 cents for that, and if we get some more follow through on the VIX side of things, which they're looking smarter and smarter by the moment, that one could turn out fairly well for them next week. Could not, for the life of me, find a decent weeklies trade on Wednesday. Got a big old goose egg there, and really Thursday and Friday not a whole lot either. Had somebody sell on Thursday, sell one Feb 7th 16 call for 44 cents, buy two of the February 7th 21 calls for 17 cents, tick in a credit of 10 cents on that trade. Part of me wonders if that was some kind of exit. And then today, just somebody buying the 15-20 call spread that expires on February 21st, paying $1.26 for the 15 calls, selling the 20 calls for 51 cents. And you're looking at a cost of 75 cents on that trade. Again, maybe looking for some follow through. And then I got distracted by the big whale trade. Yeah, and that's what's in my notes. We've already talked about that. And that's not in weeklies.
Yeah, we can get to a little bit of his performance. We touched on it before, but we can update it with this new trade. By the way, Mr. Rhodes, seems like your segment is developing a following, and a lot of people like to tune into your thing. Looks like your buddy there, Giorgio, formerly of Saxo Bank, distracting me during the segment, tweeting out a very distracting GIF of I'm not sure if this is supposed to be him dancing, listening to your segment, or how he pictures you dancing. It's someone dancing a little bit disturbingly. So clearly the fans of your segment are growing. That has distracted me completely. I will attempt to recover my bearings here as we move on. Let me just switch away from that tab. Oh, that's much better. All right, there we go. Let's move on to the big VIX mothership options. As you guys mentioned, it is whale day yet again here. He's back doing size. We're pushing, as we hear, right around 12:30 Central Time, listeners. We're pushing 3.3 million contracts. Not quite a record. I think the record, Mr. Rhodes will have the data, I'm sure, somewhere. I believe the record is somewhere around 3.4 million contracts, so we're not quite at a record, I don't believe yet, but looks like we're on pace to do it. If we just do a few 100,000 more contracts throughout the rest of the day, we should be there, but I'm sure he'll have the exact number in a little bit. But yes, the whale distorting all things out there. But it has been a pretty hectic and busy week, as you might imagine, in the regular VIX options complex as well. Most of the days, actually every day this week, north of the ADV, which is hovering right now right around 785,000 contracts. So fairly lofty out there as well. Yesterday doing 943,000, over a million, pretty much every other day the rest of this week. So like I said, 3.3 or so million already on the tape today. Wednesday, 1.1 million. Tuesday, 1.3 million. Monday, 1.1 million as well. That call to put hovering right around the 3.9 to 1 ratio. So Mr. Rhodes can breathe a sigh of relief. He gets nervous when things get above 4 in the VIX call to put range. So below 4, even at a 3.9, he can relax. At least what is relaxing for Russell, which is still usually his normal level of agitation. Moving on to the hot VIX strikes, the big positions. Number one with a bullet out there yet again. You guys can pick your poison. Of course, this is going to change now that he has rolled. So these are obviously the open interest positions coming into today's session. This will all be different by next week's show. You can probably guess what they're going to be, but I'll leave that up to your imagination. As of this morning, it was the Feb 25s lighting it up to the tune of 573,000 contracts open there. Number two, the Feb 15s, 571,000. So hot on his heels, only 2,000 contracts separating the two. Then we drop off a bit to number three, the Feb 22s, 440,000. Number four, the first and only put on the list, also the third leg of our friend the Whale's three-legged trade there. The Feb 12 puts, 440,000 open there. Number five, the Feb 16s, 426,000 contracts. And we drop off a bit again to number six, 361,000 of the March 22s out there. Number seven, the Feb 17s, 342,000 contracts there. Number eight, the Feb 20s, 309, almost 310,000 contracts. Number nine, the Feb 19s, 291,000, and round out the top 10, all pretty hefty, all almost above 300,000. We got the APE 22s, the first and only APE on the list, doing 290,000 contracts open out there. Total of nearly 14 million, 13.7 million contracts open out there in VIX land right now. That's going to change once today's numbers hit the tape. About 11 million on the calls and about 2.7 million or so open on the puts. Before we move on from all things mothership VIX options there, Mr. Meatball, aside from our friend today, who pretty much is just sucking up all the oxygen in the room, has been distorting the VIX landscape for months now. Anything else catching your eye out there, sir?
Well, let's talk about VIX futures. There is.
What are those? I don't know what you're talking about.
I'll tell you, SIBO has. I know Russell can't comment on that, but I can tell you that Jay Kawa has a ice cold bottle of champagne at home right now to pop after the bell, because they are. I would be less than shocked if they don't crush their weekly record this week. They've already put up over 400,000 contracts today. They're going to put up. I think they put up 500,000 the last couple of at least one day this week. I know they put up over 300,000 almost every day this week. Volume's been super heavy. I don't think they've announced volume numbers yet for January. If they did, then I didn't see it. But I would be shocked if they didn't break records last month at SIBO for how well everything is moving. It was just it's been pretty nuts. And now that we're backward. One thing I think a lot of traders are used to seeing is at the end of the day, right, the VIX kind of gets sold off and the VIX futures get sold off, and you get this kind of move on the roll that the ETNs have to deal with. VXX, VXXB, UVXY, SVXY, VIXY, all those XIV, all those fun names. It used to be at the end of the day there'd be some significant futures pressure created by that roll, and that's under normal contango conditions. Well, now that we're backward, we're starting to get a pretty significant buy roll to close. I was talking to you might know a guy named Mike Thompson, Mark, and
never heard of him.
We're going back. By the end of the day, I
believe he steals my tchotchkes in the studio here.
He does steal your chat. That was Matt. That had Trap Jaw in his pocket. Do you know there's going to be a He-Man movie in 2019?
I'm breathlessly awaiting it, sir.
I know.
Or dreading
I can't
it, one
wait.
or the other.
But anyway, the He-Man movies aside, they're going to have close to, probably over 20,000 VIX futures to buy in March on the close, and over 10 to buy in Feb on the close. There's going to be some serious upside pressure if we stay here. If things get worse, one thing to be aware of, as the market falls off and VIX rallies, the end of day buying pressure goes up and up and up, and we're we get a nice move like this, you could see a significant move into the close in March and Feb, and with the amount they need to buy, maybe that could flatten up that curve. But the VIX futures curve is, like I said, we're backward now and nicely backward. So now I'm just waiting to see when March is going to get over April. If March gets over April, that is going to be my big ol' hedge the world signal.
I like that. Nicely backwards. Mark Sebastian says VIX futures curve is hashtag nicely backward. We'll have to put that out there on your behalf. But yeah, I do have the numbers here. I don't have the SIBO numbers yet, but I do have the numbers from our friends over there at OCC who clear all of those futures. And it was a pretty strong January for them, as you might imagine. Cleared futures volume at OCC was nearly 12 million contracts, 11.9 million contracts in January. That's a 23% increase from Jan of last year. That's mostly VIX, as you can guess, but it does include our newcomer friend, the SIBO Bitcoin futures, who did about 150,000 contracts in January. So the rest of that is pretty much VIX. So you can kind of do the math there yourself and kind of determine exactly what a strong year and month it was. But I think you're right. I think the SIBO, the CFE people, I should say, are probably pretty happy with this week's numbers. Speaking of numbers, really quick, Mr. Rhodes, off the top of your head, because I know you have this data just on the tip of your tongue. What is the outstanding record for VIX options volume? Is it around 3.4? Was I right, or was it higher?
It's around 3.1.
Oh, is it? So we are in record territory then. I thought it was higher for some reason.
I'm not supposed to say the second part of what you just said out loud until there's some.
So we're gonna get there.
Yeah, we're looking pretty darn good.
What's been the busiest CFE day this week for Russell? Because I was commenting that they're blowing the doors off for futures volume right now, and you're getting a really nice correlation between the Feb future and Feb right now. That is doing its job.
You know, what's amazing about the way our volume grows, we have a really nice steady, grind higher with volume growth in the low volatility environment, because everybody's taking advantage of the drift into expiration, which smart people like to go out and talk about. But then when we get, when volatility actually moves to the upside, that's actually when we really see some nice spikes in volume. And that's what we've gotten this past week. And it's been a while since we've benefited from the VIX spike, as opposed to people just taking advantage of the constant drift lower.
This is definitely.
We are popping the crystal on the glass bridge between here and the Board of Trade.
I've already seen right now in front of the SIBO, there are all of these stretch Hummer limos out front, and stretch Escalade limos. Jay's out there with buckets of crystal. But yeah, Russell, right now, I'm looking at the volume, 415,000 already today. And we still have a couple hours in the day. Do you know what the daily record is off the top of your head?
Oh gosh, it's much, much, much higher than that.
Yeah, but the average week, this is really, the average all week has been over 300,000. That's got to be just awesome. And again, they're doing their job. And one thing I do want to comment, and we can kick this to our guest as well. Mike and myself and a few other people, the one thing to think about is that VIX and VIX futures are one of the few things that really do an excellent job of hedging off basis risk, and as a non-direct asset for hedging off risk in credit. So there may be some credit people, and we know that there may be some credit people that are in here trading VIX futures around, a portfolio of corporates, a portfolio of junk debt, you name it, because VIX futures do a very good job of hedging some of the hedging the interest rate risk that is not directly tied to movement in the U.S. Treasuries. Now, we're getting real good movements in the U.S. Treasuries, but much higher in the 10-year. What happens to all that corporate debt, junk debt that everybody on the world owns? Why would you own junk debt when you can own U.S. government junk debt, right? But and so I'm wondering whether some of the volume that we're seeing, some of the action we're seeing in Feb and in March is directly tied to the credit markets.
There's most definitely a correlation between the two.
Don, I know you watch a lot of different factors out there in the space. Are you keeping an eye on this correlation that Mark was kind of just alluded to between the fixed income and the VIX complex, as well as a lot of the other topics we were just hitting on, of course, records out there in VIX futures. I don't know how much the VIX futures term structure plays into what you guys do, but you have to at least, I'm sure, be cognizant of what's going on out there, as well as, of course, you mentioned at the top of the show, our friend there, the VIX whale. Sounds like you're tracking that trade as well. So it sounds like you have a lot of things, different irons in the fire over there in the VIX complex. Which of these is really top of mind for you guys over there these days?
Was that for me, for Don?
That was for you. I think you're the only Don here, unless Mark was impersonating you again.
I think I didn't hear it in the midst of the conversation. First of all, I'd like to say that there is definitively an interest in people in the credit world utilizing the VIX. We have had conversations with people where that has come up on more than one occasion. So, and interestingly, it's come up with respect to people that are outside of the U.S. as well, that have talked about utilizing VIX futures as a form of a hedge to a dislocation in the fixed income arena, even though there is a substantial disconnect and it isn't directly correlated. They feel that if you price the CDS space in a lot of their holdings, this has more direct responsiveness on certain size moves, which is very interesting. I haven't seen the research to indicate that, but we have heard that, particularly coming from regions where interest rates are lower than ours even, and people are worried about that paper that they're forced to own. So in reference to your question, Mark, about other things that we've seen that we find particularly interesting, I actually pay keen attention to volume that is in farther out months in the VIX. And there was a trade in the last couple days that was, I believe, 20,000 contracts on the July 11 line. There was a put buyer. And I've scanned, and I periodically scan the open interest in anything beyond the front 3 months. And it seems to me, although I'll defer to Russell, it seems to me that it's been growing a little bit. And this seems to be coming from people in the U.S. that are in the hedge fund space that are playing a larger vol-of-vol move in longer maturities, and may be reflective of the fact that gamma has been, as we all know and lament, has been a difficult proposition for people to cover from a realized perspective. And yet we seem to have reached a bottom in longer maturity volatility, and we're seeing that obviously now as we've flattened dramatically or even inverted in the very short end of the VIX term structure. And I think as Russell had made note of, VIX Cash has been trading elevated to the front month future for a few days now, and the open interest continues to surprise me. And I'm talking about open interest that's beyond where the whale moved today. So I'm talking about the May, June, and July period. There seems to be some interest in owning real vol-of-vol out there, which I find potentially positive with respect to people expecting volume increases in the VIX space as we go through the rest of this first quarter.
Hey, right. I'm looking here as you were talking, and I'm just parsing these out-of-the-money puts here in VIX in July. And you're right, nearly 40,000 open on that 11 strike alone. There's actually a decent amount of open interest on the 13s as well, which weren't in the money or weren't out of the money till a couple of days ago and are still kind of close. But yeah, you're right. It's interesting to see all this paper kind of stacking up a little bit farther out. We like to talk weeklies here as well as near-term stuff, but a lot of interesting things occurring a little bit farther beyond the first few months as well. Speaking of interesting things that are occurring right now, you guys are hitting us up. You want us to talk about it, so we'll get to it. We'll get to a little bit of some earnings volatility. Obviously, out here it's been just an action-packed week on the earnings front. You guys can't get enough of it. And it has been a lot of the big names. It was mostly tech-heavy names popping off this week. Earlier this week, we saw Facebook and good old Microsoft. And later, of course, last night after the bell, we saw Apple and Alphabet, a.k.a. Google. I'll never get that one right. And Amazon and a few others. And it seems like, last cycle, particularly this period last cycle, right around this Thursday at this time, all the big names, everything was just blowing the doors off. So the narrative was, dramatic outperformance, pricing in this level of vol, pricing in this level of a straddle, and then just blowing the doors off that 2x, 3x, 4x, a lot of the big names. So it seemed like we were maybe inevitably poised for a bit of a underperformance on this cycle. It seems like these things go in waves. And with all that juice priced in from last time, you're probably going to get a little bit of underperformance. And that seems to be, for the most part, the narrative we're seeing playing out, at least with a lot of the big names this cycle. A few of them are coming in line, like Facebook kicking it off this week. Well, not kicking it off, but one of the bigger names coming out on Wednesday there. They were pricing in, they closed right around 189 or 188 or so, and they're pricing in around $10, so a little over 5%. They moved up about almost that much intraday afterwards, about $8.50, so not quite living up to their level of vol, but pretty close. Microsoft was an interesting one. A lot of people were talking about it. In fact, we had Matt Amberson on the show last week, and his team over there at ORATS crunches a lot of earnings data, which is kind of interesting. And one of the ones they were particularly focused on was Microsoft. It's, in recent years, Microsoft was kind of a boring name, quite frankly, from earnings. They would always, underperform whatever the straddle was. They would not move it. So it was a very reliable premium right. In the last year and a half, 2 years, that narrative has kind of changed. They've been outperforming a bit, and they did dramatically so last cycle. And so the numbers are looking at, depending how you parsed it and how the ORATS guys did, they were looking for about a 120% move to the straddle out there for Microsoft. And it seemed like it was just poised to outperform what they were pricing in. And they were pricing in about $5. It closed a little bit shy of 100, so right around 5%. And what we saw, people were projecting about a move a little bit more than that, obviously. What we ended up seeing was the stock opened the next day, almost literally unched after earnings, down about a dime. So all that juice. And intraday, it had about a 2.5 point range. So if you were a very adept gamma scalper, you could have maybe made some of your money back, but it was this one did not live up to the hype. A lot of people I know were watching Microsoft, and it didn't outperform. Later on in the week, it may have had a little bit more of a move, but in the intervening time there, it's off about $3 now. So if you waited a bit and were very patient, which I know earnings trading and patience usually don't go hand in hand, then it could have worked out a little better. Not quite good, but a little better. But in this case, not so much. So that was a name most people were focused on. Of course, Apple coming out after the bell last night as well. They're pricing in about $7, or a little over 4%, and they ended up opening up only down like about a little over $1 and change. Intraday, they've dropped a bit more. Obviously, right now as we're talking, they're off about 3.5%. So getting close to in line. Obviously, the street weighing on some of those numbers about production and sales of iPhones, things like that. So still, though, an underperformance when it comes to all things earnings, volatility, kind of a similar, well, actually about an inline story when you get to good old Google, a.k.a. Alphabet. They were pricing in, let's see, right around 5%, a little bit shy of that. And they ended up about a $55 straddle, and they ended up dropping down on the open about $55, so close to it. So right about pretty much in line with good old Google. And as we're recording right now, they're off nearly 5% intraday. So right about where they were pricing things in. And last but not least, it seems like you can't name any industry these days. Healthcare, organic groceries, I don't care what it is, that doesn't invoke Amazon in some way, shape, or form. They were pricing in about $92, so right about 6.5%. And they ended up moving about $88 in the open, right after the open, I should say, and trading up about $100 and change. intraday for Amazon before giving up a lot of that now. They're only up about 4.8% or so now intraday. I know, Mr. Russell, we people are writing in about Twitter and other things. Yeah, they're on the horizon next week as well. We'll be watching them next week. I know, Russell, you like to watch a lot of earnings over there. In your former life, at least over there at the Institute, are you still keeping an eye on this? And any of these names really, A, are any of these names really resonating to you? And B, are you kind of on board with, seems like this cycle a little bit more leaning towards the underperformance category?
I definitely the latter of what you just said, and it comes from we have a little noticed index called the implied correlation index.
Oh, I love that index.
That talks about that basically takes a look at the implied volatility on options on a basket of big stocks versus the S&P 500 implied volatility. And that thing has been making new lows. And I think it actually is an indication of concern to the down, or, typically concern for earnings would be to the downside. Typically, maybe extra hedging around earnings would be to the downside as well. And I think that's one of the reasons we've seen a pretty extreme move on the implied correlation index. And Mark Sebastian, I heard you in the background saying you love the implied correlation index.
I do. It's one of my favorites. I think, it really does help give us an idea of whether the market is moving because of, because of just beta, or whether there's winners and losers. Mm-hmm. That's what's so great about it.
And Don, I know you guys are mostly focused on the macro trends and the macro indices. Anything about earnings season that really resonates for you? We had some interesting data a couple of weeks ago, out of Cowen and Company, I believe, showing that earnings season actually tends to clamp down, usually, obviously this week notwithstanding, usually tends to clamp down on broad index volatility. Are these correlations you pay attention to over there?
Well, the only aspect of it that we do pay attention to is the percentage of big caps that end up beating versus sort of coming in line, or missing versus coming in line. And it hasn't been a dramatic trend indicator with respect to index volatility, because the extent of the moves when there is a miss or a beat hasn't been too remarkable for the what I would call super big caps, if you will. So we do look for that, because if there has a trend, if there's a trend that develops to where a few beat, and I think we're about just past the halfway point now, or maybe 60% of the way through the earnings cycle for most of the S&P 500 names, we would have had a trend already start to exhibit itself or show itself. And so from a increase or decrease in index volatility, it's kind of a non-event for us right now.
It's not a non-event, though, for us listeners. It's your questions. We always try to squeeze at least a few in. We'll see how many we can get to today in the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the Vol voicemail. You know the drill. Let's get to some of your questions. We got a bunch. By the way, you asking in the chat there how the Twitter earnings are calculated. I'm not sure what you mean by that. You mean like the straddle? That one's pretty straightforward. But if you have something else, let us know. We got a lot of good questions here. ILM78. Don, this is actually a good one for you. He or she asking, it seems like the volatility space is dominated by Canadian pension funds. Yeah, I can concur on that one. The Canadians seem to have a leg up in the vol space. Why is that the case? How's the volatility landscape for U.S. pension and hedge funds out there? Do U.S. pension funds trade a lot of VIX options or OTC? Well, Don, this one's kind of in your wheelhouse, so I'll give you first crack at it. First off, maybe explain to our audience why there are so many Canadian funds playing in the vol space more so than I think a lot of other countries certainly. And then maybe B, what do you see a lot of the U.S. funds that you talk to? Do they play in listed VIX options? Do they trade OCC? Do they not play at all? What do you have to say here for our listener, the creatively named ILM78?
There you go. Well, I will say, without being jingoistic about the U.S., the reason Canadians have always been a little more comfortable in the VIX space or the volatility space overall is there is a large contingent of former French equity derivative traders that have found their way to the Montreal and Toronto-based entities that are fairly active and, most importantly, run their own internal capital markets groups. There are several people who have spoken at SIBO events in the past who strongly advocate towards either utilizing your own internal team from a pension community and or outsourcing the activity, but making sure that you don't miss out on the opportunity to use every tool in the toolbox. So the Canadian pension and asset management space is definitely, as a percentage of market share, been running at a much higher level from our vantage point in the derivative space. In the U.S., it's a little bifurcated. There are some, I won't say smaller pensions, but medium-sized pension entities who are comfortable in the derivative space, and there are certainly some larger state pension plans that have been either directly or indirectly involved in the pension space. That's also to say that there are some endowments that have been active, and even locally here in Illinois, some endowments that have brought senior risk managers on board that have engaged in tail risk orientations and protective postures, fairly self-directed, as well as allocating to outsourced managers. But it is still a bit of a process to get people comfortable. And it is the old adage, nobody wants to be the first to do anything. But there are certainly several dozen players in the pension community in the U.S. that are regular participants, and I know that Russell would certainly be able to add into this, that actively participate in posturing in the derivative space, as well as in symposiums and sort of getting the good word out, if you will, to fight the good fight.
Mr. Rhodes, any thought on this? I know obviously you participate in a lot of the different conferences, including RMC, where there have been many Canadian, and by the way, I like your analysis of that. That does make sense, because I used to always joke when I was in the SPX that whenever the phone rang, there was a good, at least 30% chance that it was a French accent on the other side of that phone. So there always has been a strong penetration of the French with derivatives for whatever reason, particularly SPX. So it makes sense. Maybe some of those guys would find their way over across the pond here and set up shop in Canada. But Russell, any thoughts here on the fund landscape for volatility from ILM78?
Yeah, it actually is. It's working its way south. So without tipping my hand to the people that we talk to that are becoming more interested in the volatility landscape, but it's the Canadian. There probably is a Canadian dominance, but when people start to see what works, they pay attention to what's working, become more interested in it, and it's something that is gaining wider acceptance in the States. I mean, that's part of the reason we keep growing the volumes when nothing's going on in VIX, right there.
Yeah, and speaking of getting the acceptance, I don't know if our crystal ball is gaining acceptance. We're going to do it anyway, though, because it's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, you guys know what time it is. Time for us all to embarrass ourselves wildly and recklessly. And we did a good job of that last week. All of us were pretty much markedly lower than where the VIX Cash is right now, including Mr. Rhodes. Actually, his counterpart, Kevin, there, who was doing his doppelganger duty there. The closest we had actually was the Meatball. He was pretty high, but still not high enough. He was 13 and a quarter, with the caveat he had to have a down 12 day in the SPX. Well, we got more than that today, Mr. Meatball, so you're doing good there. But yeah, 13 and a quarter. VIX Cash going out right around 15 and a half. As we're ending the show. So lofty levels, all of us, the rest of us down fighting over the 10 handle. So not too close when it comes to all things VIX Cash. That said, Mr. Meatball, if we still got you there, do you have a guess for this coming week, sir?
I do, and how smart am I? I told you that we would see some craziness. But now the caveat here was I was making a bet against my own position. So
there you go.
While I maybe won here, there are other places where it could have been a little better for me.
But, you win in the crystal ball money, which is the most important money of all.
The main point, all right, so I would be like, 14.
So a bit still, compared to last week, incredibly elevated, but of course a little bit lower than before. I know you got to run, so if you want to do, where can we find your stuff, Mr. Meatball, if you want to go check out the funds and everything else?
If you want to check Carmenline Capital, if you want to hear about Carmenline, and if you want to go to Option Pit to learn about options, optionpit.com.
There you go. Check him out, listeners, and we'll see if his pick comes in this week. Don, this is, of course, the portion of the show where we just surrender to the vagaries of the volatility space. So your job now, sir, is to attempt to wrestle that slippery, greased VIX pig and try to figure out where it's going to be at exactly this time next week, right at the end of our show. So this is VIX Cash, not futures or anything else. So what is your inner crystal ball telling you, sir?
Well, looking at how tightly bunched everyone was around 10 last week and being fortunate enough to be second in this prognostication pool, I'm going to go the other way for several reasons. I'm going to go with 17.5 for this time next week. And I'm doing it for a couple of reasons that we alluded to previously. The fact that we've been in backwardation for a few days and it's held. It hasn't been a blow-off move to the upside, but a creep, if you will, that's happened every hour. So I think we're still going to be in a land of elevated nervousness, and I think I'm going to go with 17.5.
Wow, we haven't seen a prediction that lofty in quite some time. Perhaps a sign of the times, listeners. Perhaps a sign that this the 2017 volatility regime, perhaps, keyword perhaps there, is coming to a close. Mr. Rhodes, you were next closest, so you get to go. I was bringing up the rear this week. Not my best week, even though I did win last year, so I'll still bask in that glory. But Mr. Rhodes, what are you feeling for this time next week?
It's kind of odd. I'm going to have a very difficult time going above.
Yeah, you're not 17. The highest guy anymore. You must feel weird.
I know. Oh my goodness gracious! I'm going to go with 1567. Nothing's going to happen over the next week.
An intriguingly precise number. I like it. So we got quite the range, listeners. 14 to 17.5. Don playing the Russell card this week and getting the serious upside. And let's see. I shall go last here. I like going first, but c'est la vie. I shall now work within the ranges allotted to me. I don't know. I'm kind of liking. I'm gonna buck the trend here. I can feel what Don's putting down here. I can see what you're putting down there as well, Mr. Rhodes. So I'm feeling a little more the opposite. I'm going to keep fighting. I'm going to be like you last year. I'm going to keep fighting the trend until it just bites me in the face. So I'm going to go a little bit south. I'm going to say 13.5 for this time next week. So what a range we got, listeners. 13.5 on the downside, 17.5, 4-handle range. Been some time since we had a range this lofty, this wide on the old show. That music, though, listeners, means we've come to the end of an epic journey. What an epic journey it was through the world of volatility. We talked a whole bunch of earnings vol, talked a bunch of all things VIX. Our friend the whale back and playing yet again, or the elephant, call him the mammal of your choice. He sighs no matter what you call him. Term structure, all sorts of fun stuff going on got to one of your questions at least. We got many more. We'll get to more on future shows. Don't worry. But before we go, one last time back around the horn. Don, as our guest, I will give you pride of place. If our listeners are out there and maybe they want to take advantage of your expertise or they want to learn more about what you guys do, where should they go? What should they do, Don? As well as if you have any other upcoming appearances or things you want to plug, have at it.
Equity Risk Control Group, which is our website, and you will find relevant information and contact information regarding what we're focused on. We are primarily institutional pools of capital focused from a consulting perspective, and we would welcome queries in that vein. Thank you for the opportunity.
Yeah, it was fun. You picked a good week to come on. A lot of things actually happening out there this week. Not the sleepiest of weeks when it comes to all things vol. And Mr. Rhodes, in addition to trying to educate those reporters that there are other volatility indices out there, what else is taking up your time over there at Cboe these days?
I'm going to London. Woohoo! I'm going to an academic conference in Cambridge next week. I'm going to spend some time with the good people at the Bank of England talking about cryptocurrencies. So I'm continuing to be pulled away from my first love, volatility.
Yeah, they're luring you to the dark side over there. I'll stop calling you Dr. VIX, start calling you Dr. Crypto pretty soon out there. Is it too late to change your thesis dissertation topic? Because you might want to do that. That's the hot thing. All right, listeners, on behalf of Mr. Rhodes and Don and the Meatball, who had to run, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, all the fun stuff that you do. If you guys like this stuff, you want us to talk a little bit more about all things vol on the futures option side of the space, including we've got a great guest coming on talking about all things rates, so volatility in the rate space, which we alluded to here today, as well as, I think we'll get to a little bit of crypto over there as well as energy and all the other fun stuff. So the skew, the vol, the unusual activity, all that fun stuff. Stay tuned. Come back. If you're listening live, come back in about 25 minutes for Twyfo. If not, we'll see you on the old podcast, and we'll see you for this show next week with more Volatility Views.
Volatility Views is brought to you by Cboe. Cboe is one of the world's largest exchange holding companies, and we're inspired every day to innovate some of the industry's most powerful products, technology, and solutions. We're the industry's leading force driving access to global markets. A better trading experience and powerful data and analytics to inform better strategies. We're committed to engineering new ways to help our customers realize their potential and navigate the marketplace of tomorrow, today. Visit Cboe.com. That's CBOE.com to learn more about our expanded offerings.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.